Okay, shall we get started? Okay, hello, I'm Stacey Meadwell and welcome to this roundtable to discuss some brand new research and a review of the shared ownership market. This research comes at a poignant moment because demand for shared ownership has never been higher. House price rises have outstripped wage growth for several years now, and demand for shared ownership has just gone up and up. It also comes at a time when the government has announced a raft of proposals to make shared ownership more accessible. So this roundtable is going to discuss the shared ownership market, the research that's been done by Cambridge University and the government's proposals. But before we kick off, I just want to run quickly through the outline for the session. The first half, we're going to hear from 4 brilliant speakers. We've got Dr Gemma Burgess, who's a professor at Cambridge University. We've got Kush Rawal, who's the Director of Residential Investment at Metropolitan Thames Valley Housing. We've got Jon Lord, who's the Managing Director of Metro Finance, and Ben Fry, who's Head of Housing Investment at Gresham House. Now, there's going to be plenty of opportunity for you to get involved. We've got 3 flash polls that are going on in the first half. And then in the second half of the session, I'm going to be taking your questions and putting them to our panelists. Now, you can submit your questions via the Q&A function. If there is a particular panelist that you want to submit your question to, please make a note of that. And also, if you want to see the report, you can download that now. The link is in the chat function. So that's the Q&A function for the questions and the chat function for the link to the report. And just to let you know, this session is also being recorded. So let's get started. We aim to have this all wrapped up by 11 o'clock. So let's go over to Gemma.
So good morning and many thanks, Stacey, and many thanks to Metropolitan Thames Valley Housing for commissioning this research. As Stacey said, I run the Centre for Housing and Planning Research at the University of Cambridge, and we've conducted various pieces of analysis of the shared ownership sector over the years. The aim of this particular piece of research was to provide an analysis of the shared ownership sector in 2020. As many of you will be aware, there is no single source of data that provides information about shared ownership. So the research collected primary and secondary data, which is available in a report of the key findings, with appendices containing all the data and the analysis. The project collected quantitative data through a web-based survey of shared ownership providers and through analysis of secondary data sources. These included the MHCLG live tables, SDR, and core data. The research also collected data from qualitative interviews with shared ownership providers, lenders and mortgage brokers, and wider industry stakeholders. The aim of the interviews was to discuss in more depth the supply side of the market and management issues such as arrears and responses to the pandemic. But before an overview of the data, just for a little context, I'm sitting here in Cambridge, where the average house price is almost 14 times average earnings, where the average sale price rose 4.7% between April and September last year to over £530,000, where the average rental price of a 2-bed home in Cambridge City was £1,271 a month in the year to September 2020, and where only 4 new social rented homes have been completed since 2017. So moving on to draw out just the key findings from the research. Shared ownership providers, lenders, and wider industry stakeholders interviewed for the research were all very positive about what shared ownership offers to customers. In many parts of the country, interviewees felt that shared ownership is the only realistic route into home ownership for households with relatively low deposits. The product offers flexibility as it opens home ownership at a range of possible price points to households with modest deposits. The combination of a long-term rental income plus an initial capital receipt was seen as a strength of the product by providers and a factor that made the product both flexible from a business model perspective and relatively low risk. Most interviewees highlighted also the important role that shared ownership plays in creating mixed communities. There were still concerns that some prospective buyers do not fully understand shared ownership and particularly leasehold in general. Most interviewees felt that there still needed to be greater awareness about shared ownership and that a consistent message about the product was needed across the sector. Turning to the shared ownership product breakdown, the SDR recorded 180,688 shared ownership properties in 2018-19 in England. But the number of shared ownership homes built has increased in recent years. So since 2015-16, the number of shared ownership completions per year has increased from just over 4,000 a year to just over 17,000. Nearly half of the shared ownership homes completed in the last 5 years were built in London and the South East. Two-bedroom homes were the most common size of homes sold at 58%. In total, there were 10,847 shared ownership sales recorded in core in 2017-18, 42% of which were flats. Looking at the buyer profile, the majority of shared ownership purchasers are aged between 20 and 40, with the late 20s being the most common time to purchase. Only 5% of buyers are aged over 65, but they are there. The majority of shared ownership purchasers were childless households, with single adult households outnumbering couples, which really shows who this market is catering to. The average market value of shared ownership properties purchased in 2018-19 was £265,000, with the average initial share purchase being 42% and an average deposit of £24,600. Now, the size of the initial stake purchased varies substantially by region. The proportion of sales where the buyers purchased 60% or more of the market value as their initial stake over the period 2014 to 19 was highest in the Northwest, Yorkshire and Humber and the Northeast, and lowest in London and the Southwest. Not a surprise given house prices. Around 2 to 3% of shared owners staircase to 100% each year. Core data show that of the shared ownership properties sold in 2017-18, 37%, just over 4,000 units, were resales, which is just over 2% of the shared ownership stock. Now, changes were announced to the shared ownership product just as the research began, so the research participants were all asked about their views. Now, most survey respondents thought that the option of purchasing a 10% share and lack of responsibility for repairs and maintenance for the first 10 years will make the new model more attractive to buyers and will increase demand. However, most survey respondents believed that the proposed changes will reduce the supply of shared ownership properties that they are able to build. There was concern that 10% shares would create a form of marginal home ownership with a higher rent burden that may not be sustainable for shared owners over the long term. Lenders have a minimum amount they will provide a mortgage for, and in many areas, a 10% share was likely to fall below this threshold. Despite the reservations about the option of purchasing a 10% share, both lenders and providers were not convinced that many buyers would purchase a 10% share in reality. Because of the requirement to purchase the maximum share affordable, they thought that most potential buyers would be found to be able to afford more than 10%. The average share purchased is just over 40%. This has changed very little over the last 5 years. Little concern was raised about the ability to staircase in 1% increments, but some did not expect to see significant take-up. Now, most providers were quite concerned about the announcement that they will be expected to cover all costs of any repairs and maintenance for 10 years, particularly if these higher costs were not reflected in higher grant levels. Most providers highlighted the need for clarity about the announcement, as there were very mixed views about what might be considered legitimate repairs and maintenance, and concerns about how far providers would be responsible. Most providers interviewed had steadily increased their shared ownership portfolio over time. And over the next 5 years, most intended to build or take on more shared ownership, or at least deliver about the same. However, there were economic uncertainties caused by the pandemic and by Brexit that made it difficult to say how accurate these plans would be, even if demand was currently strong. All interviews were asked about the impact of the pandemic on the shared ownership sector. The most immediate impact had been an increase in demand for shared ownership lending and in inquiries about buying a shared ownership home. Interviewees were asked if they had seen any recent increases in arrears, reverse staircasing or repossessions. Most said that so far they had seen little change and that it was too early to really determine what impact the pandemic would have on existing shared owners. There was a strong consensus that the job protection schemes put in place by government had so far protected the shared ownership sector from a significant rise in arrears. Now, a final key issue in the sector addressed in the research was the impact of EWS1 forms. Following the Grenfell tragedy, UK Finance, the Building Societies Association, and the Royal Institute of Chartered Surveyors collaborated to create the External Wall Survey in December 2019. Almost all of the interviewees said that this was the issue that was most concerning for the sector. The impact on existing shared owners in flats was described as being extremely negative and was holding up sales. Most interviewees felt that unless something changed, it would take many years for the sector to work through these issues, and all felt that further government intervention was required, such as underwriting insurance risk. So thank you very much. That's a very brief overview of the results of the survey and the interviews and the secondary data. You can find all of the details in the report, and back to you, Stacey.
Thank you very much, Gemma. That was a brilliant overview, and I'm sure you can tell from just those few minutes of what Gemma said that there's a lot of information in that report, which you can download now. The link is in the chat. Before we go on to our next speaker, we want to do our first poll. And if we can bring the poll question up, we're going to have 30 seconds to answer this. How important is delivering shared ownership housing to your organisation? So you've got 30 seconds to choose your answer, and we'll go straight into the results. Don't forget to submit your questions for our speakers via the Q&A function which I think is at the bottom of the screen. There's going to be plenty of time to get to your questions at the end, but do start submitting them now. I know a few people have already submitted some questions when they registered. So has everybody chosen their answer? Let's see what the results are. Okay, let's have a look at the results. So that was overwhelmingly, it's a central part of what we're here to do, which leads us nicely on to our next speaker, Kush from Metropolitan Housing.
Thank you, Stacey, and good morning, everyone. So clearly that wasn't a trick question we were asking. It was really just to get a sense check of our audience here today. And I'm pleased to say that we're all largely here and we see shared ownership as an important part of our mission. And when we reflect on that shift of thinking and priorities, you know, for me, someone like me who's been in the sector for over 15 years, I've seen that real shift gently happening where shared ownership has become more and more important to the work that we do. And as Gemma highlighted, there's been a real continued upward growth in the supply of shared ownership housing over the past 8 years or so. But let's now hone in on the past 12 months, because we're here to talk about shared ownership in 2020. And I'd like to share the experience that we've had over that time period. And so Resi, we commenced last year with a little bit of a sense of worry and concern, not only for our health and those that we love, but for the economy. And like many around this virtual table, significant concerns around the impact, potential impacts that were going to happen on the property market. But what we saw at So Resi was a couple of things that really quite astounded us. We had the highest volume of inquiries generated over a 12-month period in our history. We had the highest number of sales completions in a single month ever, and reservation rates which were double that of the previous year. The demand was so strong, in fact, that the group sold out of 90% of our London pipeline in 6 months ahead of time. Now, I don't say this for a shameless plug for So Resi, because the truth be told, this phenomenon was experienced by many across the shared ownership world. And we could begin to try and consider why and what were the things that brought this all to play, but I'm going to leave the experts like Gemma and Jon to maybe comment on that. But what I would draw a conclusion on, and what I would suggest, is that the resilience, no, the elasticity of that shared ownership product has been evidenced yet again. This continued demand and growth during uncertain times was a hallmark for me in my early career. When the credit crunch hit, we had a lot of commentary and a lot of difficulty in that property market. But shared ownership sales continued largely unabated. And this is yet again, we've seen a real strong demand for this product. And there's levers that we can pull to make sure that we keep servicing that marketplace. Now, I think we all agree that this is a great product. Given the results of that poll, the fact that it's an important aspect of what we do and we believe in it, I'm going to take that as a given. We can clearly agree that the demand is there. However, we can't be complacent. We do know that things need to change. Why? Well, our customers are telling us things need to change. The government is telling us things need to change. Indeed, that inner voice from within our organizations are telling us that we can do better. The Law Commission have detailed a very comprehensive set of recommendations and considerations around improving the shared ownership experience and that of the wider leaseholder. At the end of this session, we'll be emailing you all a copy of the research as well as that detailed feedback that we've had from the Law Commission. Now, thinking about areas where we can make significant impact right here and right now to the lives of those people living in our homes, is that we can look at shining a light in the areas that customers find confusing. And that stems right at the beginning of that journey, at a point where we sell them that property. Driving consistency as a sector, telling our stories in a similar way. And the sector are doing things to try and address this. The shared ownership campaign, which seeks to mobilize this, is really setting this in motion. And if you're not involved in it, please do get in touch and we can point you in the right direction. Beyond this, having much clearer details around fees and costs through the life of the shared owners experience is something we very often hear from our customers. That whole drive to transparency is absolutely something we should be working hard to get to. And again, there are various groups working on driving this standard and working up an approach that delivers consistency. And equally, if anybody here wants to be involved in that, likewise, get in touch and we'll put you in touch with the right people. And the last point, I think, which really is such a simple fix and is a call to action for everyone here. The lease length that we offer our customers. You know, we've got a new affordable homes program coming up, but I think there's an opportunity for us as a sector, as a group of providers of shared ownership, to make a stand here and say that we know this is a problem for our customers and we are going to approach this differently. Whether we agree that it's 299 years, 599, or indeed 999 years that we want to offer as a group. This is something we as a sector can agree, deliver, and move on together. So, to the government changes. In my humble view, these really do have the potential to really improve the experience for shared owners. Moving that dial and taking heed of some of that long-standing concern and issues that have been raised by our customers. We look specifically at the 10% share, the intent of widening the offer and trying to bring as many people as possible into a grasp of a good quality home is what we're here to do, right? However, we can't lose sight of the focus, the longer term. It is our duty to think of that longer term. It's our business model to be focused on that longer term. And the risk to that customer with the sustainability of that offer over the longer term is something that does worry me personally. I think setting clear parameters around it, having the view from the lender community and their support for this is going to be key to making this a success for customers and providers. Now, I'm not going to go through each and every area. Clearly on the 1%, that's something that we've been doing for a number of years And we know that there are concerns around what it means and how it's delivered. But again, I'd implore anybody here who is worried, come speak to us. Be more than happy to show you the experience we've been through, how we've implemented it, and the impact it's having on our customers. So thank you for listening to me, and I hope that was helpful. I'm going to now hand over back to Stacey.
Thanks very much, Kush. I think you set a really good scene there for sort of where the industry where the sector has come from, but also some of the areas where things need to change to take it to the next level. We've got questions coming in via the Q&A, so keep submitting those. But before we go on to our next speaker, let's do another poll. So if we can get the question up, what's the most important thing that you believe would encourage greater lending into the market? So you've got 30 seconds to answer that question. There's a lot of queries about the link to the report. It's in the chat, and also we'll be emailing the link to the report to everybody that's registered after the round table. And please do keep submitting your questions via the Q&A. We've got some great questions coming in now. I think that's 30 seconds about up. Shall we get the results? And it's a bit of a mixed result. So 42% standardized single product and term seems to be the most popular answer, but equally plenty of people opting for significantly more supply and more performance data on existing assets. So that leads us nicely into our next speaker. Over to you, Jon.
Thanks, Stacey. Morning, everybody, and thank you for having me, Kush. I've got two subjects: 10% shares, increased demand for shared ownership mortgages. 5 minutes, so we're flying on this one. Now, first, the poll questions. I asked the same questions to a few of the key lenders in shared ownership and a couple of potential new entrants. Broadly speaking, there's no correct answer. It depends where the lender is in their own shared ownership journey, but the overwhelming responses were increased volume or increased supply, and better data on shared ownership helps them establish risk. 10% shares. So this is a really hard subject to cover in 5 minutes. It's got so many complex risk angles, so many complex factors that need to be considered, and certainly brokers who assess shared ownership, housing associations and lenders will need quite complex policies to deal with it. We've spent hours looking at the data, looking at past performance of shared ownership, sent our findings to Homes England, and hopefully they'll consider some of our suggestions in the new capital funding guide. But you guys want to know what the lenders think of it. I'm going to try and demonstrate that by way of comments that we've received from lenders. Now, these aren't official lender statements. They're a little bit raw, but hopefully it will give you a feel, and I can't name any of the lenders. So the first one, we haven't employed a minimum loan size, but that would be a consideration if 10% shares became marketplace, i.e. if they gained traction. We have actively supported shared ownership for several years and will continue. The challenge of sub 25% is not only system related, which was a common thread, but needs vigorous consideration on risk, lower incomes, risk, lower deposits, and it's reasonable to expect higher risk based on past performance of the latter two. This next one's an interesting one. The knock-on impact of the next purchase. If they have struggled to raise a 10% deposit for a 10% share, then does the increased cost of home ownership further limit their ability to save, thus effectively trapping them at a 10% share? Affordability, more of a challenge, as 90% of their property would have annual rent increases. Now, if you link that back to the perception of being trapped at 10% share with 90% increased costs, you see the point that it needs vigorous or rigorous assessment methods. Not enough disincentive to try and work through the payment issues, higher risk of throwing keys back. Now, common term lenders use is skin in the game, the skin being the deposit, the game being the mortgage and the property. And the less skin in the game, the more chance of the applicant, in the event of payment issues, of throwing the keys back. Deposits of around 1,000 or less, where they could be for 10% shares, is akin to a deposit on a rental unit. And the last one, potentially would look to enter, but not on day one. Now that may sound obvious, but it does cause a problem, because if you think about the 10% shares, they will only come to market as the grant-funded schemes are built complete. Therefore, you don't have a specific day one, a point in time when everybody will do 10% shares. And that in itself could cause an issue, not only for the customer with maybe 2-3 main lenders offering 10% shares, but for the housing association in respect of exposure, because those 10% buyers would effectively eat up the exposure of the key lenders, thus impacting on the housing association's ability to achieve, say, 40-50% for their viability model. And I think those comments, whilst raw, they do summarise the views of lenders, that they do see it as risky, and it rightly shows their concerns about it. I think on day one, the day one where the first site comes to launch, we might have 2 or 3 lenders active in the sector at 10%. So shifting up a gear into something very positive, the demand for shared ownership. I'm guessing I don't really need to say much here, because everybody in the sector can see that it's absolutely skyrocketed. At Metro and similar at TMP, we're running at 2,400 shared ownership assessments per month, up from circa 1,800 on a like-for-like 6-month period. We're seeing multiple buyers per property on new build, up to 10 buyers per property on resale. We've seen up to 50 buyers per property. I also think that will continue, maybe even increase. We've got the demise of shared ownership, that's Help to Buy equity loan, obviously not a direct competitor to shared ownership, but I think we'll still see buyers overflow into shared ownership. We've got the poor economic times. People who had a deposit for open market may now not. They will move to the easier access of shared ownership. Likewise, people whose employment has changed, they could move to the easier access of shared ownership. In short, I think the easier access of lower deposit, lower income required for shared ownership, the flexibility of the shares, will see shared ownership shine over the next few years. But that's assuming we can ramp up the supply. And if we can ramp up the supply, the lenders will follow. And I'd finish on the point that don't be deceived into thinking that we don't have enough lenders out there right now. Yes, we've got fewer lending, fewer of the 28 active at the moment because of Corona, but don't see the current service issues as a reflection of being overwhelmed by shared ownership. It's the general mortgage market, it's the stamp duty, it's the Corona. 28 lenders is easily enough for the current supply. It's comparable to the number of lenders we have for Help to Buy equity loan.
Great, thank you very much, John. Some interesting points there, particularly around the affordability of the 10% share. We're going to head into our third and final poll, but just a reminder, please submit your questions via the Q&A function, not via the chat, if you can submit them via the Q&A function. Okay, so of all the shared ownership providers currently registered with the regulator, what proportion are for profit? So we're going to have 30 seconds to choose one of those 4 options there. As I say, reminder, please submit your questions via the Q&A function, not via the chat, and I can pick them up from there and put them to the panelists. And you can download the report from the chat, the link is in there, but we will also be emailing the link to the report after the round table. So has everybody had a chance to choose an option? Shall we have a look at the results? And 44% went for 4%, which I believe is the right answer. Is that right, Ben? As you're heading into your
yeah, very much. 4% is the right answer. Yeah, thanks, Stacey. So I think that's an interesting question, and 4% in a short time shows the high level of interest in investing in social housing. So first of all, let's start by just explaining who are for-profits. So ultimately, we're regulated in the same way as traditional not-for-profit RPs, but are able to pay dividends. This means we can access a huge pool of kind of cheap long-term equity capital to bring to invest and grow the social housing sector. So this has really been a kind of panacea and goal of the sector for a long time. Crucially, there's three different types of, or generally three different types of for-profits. So number one, we have developers who are looking to control the affordable provision on their sites. Number two, we have aggregators who are looking to build portfolios and sell at a profit. And number three, we have long-term patient capital providers, such as ourselves at Gresham House and Resi, and some of the other entrants, such as Legal & General, for example, who are looking to hold the assets for their life to ultimately support paying an income to our underlying pension fund investors. So why do we like and invest in shared ownership? Ultimately, it provides a long-term source of inflation-linked income, whilst providing a social benefit through the provision of new fit-for-purpose affordable homes, generating a saving for those residents whilst compared to renting privately, which is generally their only other option. Also, because we're supported by equity funding rather than debt, staircasing and the uncertainty of cash flows that bring isn't a problem for us in the same way it is to fund for a traditional housing association looking for long-term debt financing, where those debt financing organisations, generally insurers, are looking for certainty in order to ensure their debt Solvency II compliant. We also look to reinvest all our staircasing proceeds back into new shared ownership homes. I think that's very important. So one of the things that every investor asks me is what is the reputational risk of investing in shared ownership, and does shared ownership provide a great experience for the shared owner? And ultimately, that's why we can fully support any moves to improve the shared owner experience. Something we find that is really quite interesting is we're now at a point where a number of the people who control pension funds investment, which is ultimately what we're utilising to invest, are often shared owners themselves, and they quite often ask the most challenging questions of us in terms of what are we doing to ensure we're delivering a great service to those shared owners. And building on that, we see it particularly important that housing doesn't offer a kind of Ryanair type experience where you sell the seat, or in this case the home, cheap and look to make money from ancillary services that people don't know about when they first kind of buy the product. In this case, we're talking about things like charging for lease extensions and lots of ancillary fees that drive leaseholders and shared owners completely crazy when they come to kind of do anything with their home. So when we start to look at the government proposals, we, like all things, need to look at the details and make sure that those details work. To kind of walk through those pieces, so we see the ability to shared owners to buy 1% stakes as a great thing. And when we were first investing in shared ownership 3 years ago, we saw the shared ownership plus offering from MTV as one of the great reasons to partner with them and deliver that on all of our sites. We see the kind of overriding moves to simplify leaseholding is incredibly positive. Is really the kind of house building industry here has benefited from most leaseholders just not understanding the value they're giving up through reversionary value, and particularly grossly inflating ground rents. Really kind of takes advantage of a mismatch of information between residents and buyers and the organisations behind. Considering some of the other proposals, so the ability to buy a 10% stake in theory a positive thing, expands the universe of people who can get those benefits of their own home. But we need to be especially careful that those people buying 10% firstly understand the product, and secondly can afford it for the long term, particularly when they're only able to put up a kind of small amount of capital. You've got to ensure they have enough ability for cash to be able to afford to run that home. With maintenance, ultimately, it seems to us the objective is to ensure quality homes are delivered, which I believe everyone here supports. But we do need to ensure that this isn't done through increasing the complexity of the product. I think the sector's done a great job, particularly in recent years, of making shared ownership simpler to understand and we don't want those changes to be underdone potentially through kind of multiple shared ownership offerings, or also through complexity of who is responsible for repairs. So thanks. I'll hand back to Stacey.
Brilliant. Thank you very much, Ben. And now, because we've got so many questions coming in via the Q&A, we're going to go straight into our discussion with the panelists. So if I can invite the rest of the panelists to start their videos and take themselves off mute, that would be great. And Ben, you're still on mute. There we go, brilliant. Now we've got questions about all different aspects of shared ownership, picking up on the points that have been raised. So I'm going to we'll try and get through as many of these as possible. But let's kick off. This one is for you, Kush, and I might bring Gemma in on this as well. So Resi have been doing the 1% staircasing for quite a while. What levels of take-up have you seen for that?
So we measure take-up in relation to two things: how many people sign up for it at the beginning, and then how many people exercise their right to buy more every year. So around about 85–90% of people that are offered it decide to sign up. And every year, anywhere between 12 to 20% of those who have signed up will buy an extra 1% share. So it varies year on year. But I think that's really important when we put into context. Gemma raised the point very early on that 2 to 3% of the current cohort shared owners staircase in the traditional way every year. This is significantly more when you compare it to that.
Gemma, don't know whether you have anything to add to that.
Well, just to follow on from what Kush said, so the core data records only staircasing to 100%. So the only way we can get data on partial staircasing is to ask housing providers. And we did ask in the survey, and partial staircasing is very modest at the moment. People tend to either stay with the share that they purchased, or they staircase to 100%. So first of all, we don't have very good data on partial staircasing. What we got from the survey is that it's not very common.
Maybe that's something for the next report to get a bit sort of investigate that data and get a bit more data on that area. Okay, let's go on to the next question, and this is I think Jon might be able to answer this one. Is what can lenders do to make shared ownership products more attractive to consumers and advisors, or is it the housing associations that need to be more flexible? So maybe start with Jon, and Ben possibly on this one as well, and maybe come back to Kush.
I think the products for shared ownership are attractive. If you look at, for example, Santander Nationwide, they offer the same products that they would for an open market purchase as they do for shared ownership. What you tend to find is that lenders who offer 95% would create a specific product for shared ownership because they don't have a 95% product. But I think the products are incredibly attractive. Slightly different at the moment, where it's not comparable to normal times because lenders are trying to temper volumes via criteria and rates. But in normal times, I think we have a very attractive offering.
Ben?
Yeah, so we've generally found that shared ownership day one works, but what people struggle with is the costs over time and the difficulties in staircasing. So that's particularly why we encourage the 1% staircasing offering, because it allows people to take those smaller steps up the staircasing ladder without ancillary costs, and also to reduce the costs from things like lease extensions and if people want to replace their kitchen, because ultimately these are things that should be simple for people to do. They shouldn't be kind of making money from these type of activities, and ultimately that drives customer satisfaction in shared ownership and makes it more attractive overall.
And Kush, obviously you're already putting things into place to make it more attractive, so and the government is also playing their part to do that.
Absolutely, but you know, ultimately the nut we need to crack, I don't think we've got the answer here, and that is there is a mismatch here where majority of our customers who buy a home from us say, I'm buying a share, my objective is that I want to own it outright at some point. Now, we can't make magic happen. You know, if somebody has a propensity to buy a 25% share, we can't, without some magical thing happen, without, you know, get them to buying 100%. So one thing I think we could do more as a sector and the lending community is look at that, open it up and say, right, we have got this mismatch. Is there anything else that we could be doing more collectively to work on these group of people who are mortgage use product at 25%? How can we help transition them to that ambition of getting to 100%? We might not have the answer, but I think that there is a need there potentially for an opportunity rather for dialogue with the lending community, with the HA sector, to say how can we try and approach this.
Thanks, Kush. This next question actually relates to what we were talking about before about staircasing, and it's actually directed to you, Kush, but I think Gemma might be able to, might have some thoughts on this as well. The question is, does Resi track or know of data available to show how many of their shared owners move directly into full home ownership? And I know, Gemma, this is something that you touched on at the start of the Q&A. So maybe we start with you, Gemma. Is this something, you know, you talked about the data only showing kind of people going to full ownership. Do you kind of, you know, can you track kind of how many people have done that?
So the SDR collects data on staircasing rates, but only to 100%. And if you look over time, and it's in the report, there is a chart on this. It's on average, it's between 2 and 3% of shared owners who staircase to 100% every year. The people who staircase, it varies by region. So now, converse to people buying bigger shares being in the north, the staircasing rates are actually highest in London. So staircasing is not something that we have fantastic data on and that we have a great understanding on. In the survey, we asked about partial staircasing, so staircasing to less than 100%, because that's not in the data, the formal data. And that suggested that from data from providers that partial staircasings form around 1 in 5 of all staircasing moves. So that's probably the best that we've got data-wise.
Kush, is it something that you monitor?
We do. So we have an exit survey where somebody sells on their share, predominantly, where we'll be looking at where they're moving on to. Now, I don't, off the top of my head, have the numbers available to hand, but I'll be happy to share that afterwards. But I think I am getting the sense here that we've got a little bit of a build-up to the next bit of research here, because given the questions and the sort of things that are coming up, that whole question around staircasing and the exit point is something that probably warrants quite a bit of detailed examination.
Is there also a question about people who can't afford to staircase, who are never going to be able to afford to buy the rest, and sort of how you kind of factor that in, and how you deal with that?
I think there's a broader point there, Stacey, around actually a lot of what we're talking about here today is about proposed changes, and it's a forward look, and it's looking at, you know, how are we going to improve the experience for those who are coming into it. Let's not forget we've got 185,000 plus people who have already invested their lives into this product. And, you know, my view is that we owe it to that cohort to try and improve the experience where we can for them as well. So, you know, Ben raised a point here around, at the beginning, the access, it works and you're in there, but longer term, where the rent is increasing, the costs are going up, how can we make that a more sustainable offer for them longer term? And I think there is an opportunity for us, again, as a sector, to look at that and say, right, how do we try and improve that? And equally, there are groups at the moment, whether it's the G15, the National Sales Group, and various others who are looking at these questions and saying, right, you know, a lot of the agenda is forward looking, but we have got our existing customers that we need to be thinking of too. And yeah, I think there's an opportunity there.
Right, thank you. I'm going to bring in Ben and John. This is quite a long question from Tim Preston. In order to alleviate concerns of lenders, shouldn't affordabilities be assessed based on total housing costs being 40% of net household incomes as opposed to 45%, which is the industry norm?
We looked in respect of 10% shares, does that mean, or in general shared ownership?
It doesn't specify.
I'll try and answer both. So when we do a shared ownership assessment, we look at the standard 45% debt to income ratio for mortgage and rent payments and a maximum income multiple. But aside from that, we also do including the spend for household expenditure so that we can establish that it is affordable and sustainable. So shifting it to a 40% of all costs is kind of irrelevant because we're doing that anyway on the current model. But when you look at 10% shares, you can make the assumption that they'll be purchased by applicants with lower incomes. It's obvious, really, otherwise the share would have been maximised. And when you do that, you end up, from our analysis, you end up with buyers with a smaller pool of that residual income left after all of the household costs. And that smaller pool of residual income means that it's harder for them to deal with a life event such as funeral costs or washing machine repairs or whatever, harder to recover from that. So the suggestions that we've put forward or will be putting forward to our housing associations would be to put a HA level policy, irrespective of capital funding guide, to assess the sub 25% at a maximum 35% debt to income ratio to protect the buyer, to make sure it's affordable, sustainable, and to make sure that assets protected in the longer term. We also put that forward to Homes England as well.
And I think, kind of building on what Jon said, I think it's wise to look at people's absolute income when assessing the percentage that they apply. So not apply one percentage for everyone, but apply a lower percentage to people who are more at the lower bounds of shared ownership in that kind of 20 to 30k range, and a higher percentage of income when you're at the kind of upper, getting towards the kind of 80k cap in England. And also look at the mortgage as well. So if people have a higher LTV mortgage, you generally want their outgoings to be a lower percentage of their income, because there potentially is more volatility in that mortgage rate than someone who's at say a 60% LTV mortgage. So we generally apply a much more lesser kind of one size fits all solution and focus more on the individual.
Right, thank you. I want to stay with you, Ben and Jon. Question from Ben Freeman. Do lenders differentiate between for-profit and not-for-profit RPs when it comes to mortgages?
No, providing they're a registered provider, it's fine either way.
Yes, I support that as well.
Right, okay. A question here from Marilinda Cara about staircasing data. Does your 100% staircasing, and I think this is for Gemma, does your 100% staircasing include those who staircase and sell simultaneously?
I'm not sure. I'd have to go back and have a think about what I was answering with that one. I'm not entirely sure what we're asking there.
Okay, sorry, there's a little bit of an explanation which I'll add, which may help. Is that the reason I'm asking is that some providers count those as resales and not as staircasing, which skews the staircasing.
Right, and well, I'll have to go back and look at the SDR data, because that simply records numbers of units that staircase to 100% in the data set. So this is probably something that we would need to dig much deeper into, looking at the SDR data, the core data, and talking to housing associations to see how that information is recorded in those data sets.
Great, thank you. Kush, I don't know whether you've got anything to add to that. Any you've noticed is when people are staircasing to 100%, is that when they sell, or are they generally when they sell?
Yeah, so we do have a proportion of properties that staircase to 100%, where initially someone was selling a share, and that didn't work. And I've checked with my colleagues, and they confirmed that any staircasing to 100%, irrespective of how it occurred, would be captured within our numbers. So what we report on core is any 100% staircasing.
And staying with staircasing, a question from Linda Clark. Do you think educating people about staircasing would help? As in my experience, many people don't fully understand how it works. Kush, I think that's a good one for you.
Yeah, totally. I mean, and I think it's not just about an ongoing thing. It's about the minute that they decide they want to buy into the product. You know, there's a real responsibility on us, I think, to manage expectation here and for the customer to get a very good sense of, right, my ambition is to own 100%, but let's see how far the dial has to move for me to be able to get to that position. And we work incredibly well with independent financial advisors and other experts in making sure customers get advice. All we need to be doing is having a bit more of a tweak and standardizing those conversations we're having. And then in terms of once they're in the product, you know, every year we write to the customer, we tell them what their rent is for the next year. That's a prime opportunity for us to be engaging that conversation with the customer, signposting them back to you know, our IFAs and say, look, there's an opportunity here, your rent's increasing, go and do the due diligence, go and check and see if you're able to buy any more, because you know, it's worth at least exploring. And we've been doing that for a number of years, and we've found that actually it does help. It does help because you feel, the customer feels that they're having more of a regularized conversation with you, and that we are interested in helping them achieve what they're looking to achieve.
Great, thank you, Kush. This is another question about data from Abigail Harris, and it's about satisfaction with shared ownership. Is there any recent data about satisfaction with shared ownership? Gemma, I don't know.
We did ask in the survey. So what we did was we asked housing associations whether they collected any annual information on the satisfaction of shared owners. Those that answered the question said that they, and so this is an average of averages, average satisfaction figure given was 79%. It varied between 50% and 98% of shared owners saying that they were overall satisfied in their most recent survey.
Thank you. Okay, moving on to repairs. This is a question from Susie Hollins. Do the panelists have any thoughts on whether we should be looking at levelling up the 10-year repairs term for shared owners who have purchased prior to the new shared ownership scheme becoming available? Don't know, Kush, do you want to start?
Yeah, no, absolutely. We could. I'm not sure where the money will come from to do that, though, because, you know, these schemes that were delivered and these homes that were delivered were funded on the basis of certain liability and certain costs being there. Now, clearly, to put something in retrospectively would put quite a significant hole in our finances. And as a sector, we've got a number of headwinds that are in our way. You know, we heard the discussion earlier about the cladding problems, and, you know, building safety is a big ticket item for the sector right now. We've got zero carbon coming up. We've got the need to keep delivering and providing these homes that our country so desperately needs, right? So there is, in an absolute ideal, yes, we should be trying to level up and making sure that we're putting the whole, you know, all our shared owners to a standard common approach. But the reality is that can only happen if there's significant funding made available to do that.
Thanks, Kush. Cracking straight on because we've got questions coming in thick and fast now. This is a question from Sue Phillips. Is there a risk that shared ownership plays a part in driving up house prices in the wider property market? I don't know, Gemma, whether you have any thoughts on that. Maybe Jon and Ben.
Well, not on shared ownership. There's pretty strong data that Help to Buy has pushed house prices up. But I wouldn't say that there's any robust data that says shared ownership has done the same.
I wouldn't mind coming in on that, Stacey, if that's okay. I think, you know, and I've heard this comment come out before, but I really think when you take a sit back and you look at all the protections that are put in there, how the product is delivered, all the safety guards that are put in there, and namely that these valuations that are taking place are done by an independent risk valuer who looks at the market and comes up with the valuation. I think that there's very little opportunity for that to happen. You know, the supply of these in relation to the overall supply of housing stock in the country at the moment is nothing, you know? So the potential argument that this is driving up generally house prices is not one that I could support. Absolutely, Gemma, there is report after report, including government reports, that have said that the advent of Help to Buy has potentially had an impact on house price inflation. But that product doesn't have the same safety guards as shared ownership.
And just to kind of build on that, if you look at the kind of average shared owner, they'd need house prices to drop kind of 50% before they could buy generally the equivalent home on an outright purchase basis. So yeah, that's a huge difference.
Well, while we've got you, Ben, there's a question for you here. Do you want people, this is from Ben Freeman, do you want people to staircase, or does your model work better if they don't?
So we're ambivalent to it. We want people to do what's right for them, recognising that for some people the objective is to staircase, for others they just want the security of having their own home.
Brilliant, thank you. I'm going to go to a question that was submitted before the session. We did have a few that came in early, and this is from Alan Green. Any examples of making shared ownership work in low value areas where affordable rent is actually more viable than shared ownership? But is it desirable to have more of socially sustainable mix in the scheme? I know, Gemma, in your research you looked at regional variations of where shared ownership was concentrated, and it was concentrated in the high value area.
It is. If you look at the data from 2014-15 to 18-19, which is the 4 years available, then percentage of total built being shared ownership is 3% in the northeast, 10% in the northwest, 3% in Yorkshire and Humber, 7% in the East Midlands, 7% in the West Midlands. What's very noticeable in that data, though, it's increasing over time in those lower value areas. So somebody is making it work.
Can I just add to that?
Yeah, sure. Come in, John.
We work across the whole country, and there's often a pinch point where, say, up in the northeast or some parts of the northwest, where you start to hit the 115, 120 of the overall value, where shared ownership itself fails to work because you've got the rule in the Capital Funding Guide that they can't afford to buy on the open market, and therefore the income required to buy at 115 means they can afford to buy on the open market, helping therefore to protect the social rent aspect of it.
Okay, thank you, John. We're nearly out of time, but I think we've got time to squeeze in another question. This is from Andrea Dean. What percentage of shared ownership purchasers are existing shared owners, e.g. upsizing because their current home no longer suits their needs? Maybe Kush, this is one for you.
Yeah, we have looked at that in our own data. And last year, I think it was about 3% of all sales that we did were from existing shared owners. The 15 years I've been in the sector, we've seen there is a demand, quite a strong demand from existing shared owners. And typically it's where somebody's single household, they've moved on, they've got children potentially, and they're looking for that larger family accommodation. And given the geographies we operate in, we're often able to provide that route out. But clearly this is a little bit more complex and difficult if you're particularly operating in the London patch, and that's where all your offer is. Gemma, I don't know if you picked up on
no data on that.
Brilliant. Okay, well, we are at just about at 11 o'clock. So thank you so much for all your questions that you've been submitting. We got through as many as we can, as we could in the time. And thank you very much to the speakers. I think that's been a really interesting discussion. The discussion carries on. There's going to be another report. That's right, Kush, and we're looking for kind of people to get involved with that, and we'll put an email address up so that you can, if you want to get in touch with Metropolitan about getting involved in the next report. There'll be a link going out to the current report, will be going out to everybody that's registered, so you can get hold of a copy of that. But thank you very much for joining us. I think that's been a really interesting session. Thank you very much.